Hi there, and welcome to another episode of Tax Chats. My name is Belinda and I'm a principal at RSM Australia. Today's topic for discussion is Taxation Ruling 2023-2, a ruling issued by the ATO in early June in relation to the deductibility of salary and wage costs incurred in the creation or construction of capital assets. Many businesses operate under the general rule that salary and wage costs are immediately deductible, and therefore additional consideration will need to be given to the ATO's position. The ruling formalises the ATO's position that salary and wage costs incurred in the creation or construction of capital assets are not deductible under Section 8.1 as they're capital in nature. In the ATO's view, these costs instead form part of the cost base of that asset. So while somewhat controversial and likely to add significant administrative complexity, the ruling proceeds to finalise the position adopted in Draft Ruling 2019 D6 and also provides some additional examples and comments around the apportionment of costs. It considers some of the judicial authority in this area, including the full federal court decision of the Commissioner in Star City, whereby the immediate deductibility of wages was discussed. But firstly, to begin with the ruling's application. So it applies to salary and wage costs incurred in the creation or construction of a capital asset. Salary and wages encompasses a broad spectrum of payments, including bonuses, leave-related payments, and also payments to contractors. Super, however, would not be included. Capital assets are defined as assets constructed or created which form part of the profit-yielding structure of a business or an organisation. So those assets through which the business will derive its income. It includes both tangible and intangible assets, and the ruling provides examples around the construction of buildings and factories, some mining and petroleum project examples, but it would also extend to the creation of assets such as software. The ruling applies both before and after its issue, so taxpayers who have historically been deducting salary and wage expenditure where the employees were engaged in the creation of capital assets will need to review their positions. The ATO acknowledges the starting position for salary and wages is that they would normally be on revenue account and therefore indicates that the costs need to be incurred specifically for the construction or creation of the asset. It uses language such as necessary, essential, or sufficiently connected to the construction or creation, and it also indicates that it's a matter of fact and degree. Other factors which impact on the determination of whether an employee is specifically engaged on a project include the nature and scope of the business plans, and also, in terms of employment, KPIs, and the pattern of deployment of the relevant individual. The determination of whether the costs are on capital or revenue account is made at the time the loss or outgoing is incurred, being when the salary is paid. The ruling envisages that costs in relation to a particular employee may initially be on capital account and then change to revenue, and vice versa. Where an employee is involved both in the construction or creation of an asset and other duties, apportionment of those wages will be required. The ruling indicates apportionment needs to be on a fair and reasonable basis, which takes into account the information that is available. The obvious basis is records such as timesheets, but not all businesses will keep those records. And the ruling indicates that cost centre allocations, job descriptions, diary entries, and also accounting treatment may assist in the reasonable allocation. The ATO's position is best demonstrated by the examples it provides. They are, as usual, very black and white and leave a fair bit of grey that will no doubt be disputed. If followed to the letter, they also create a fair bit of additional record keeping requirements for businesses. Example 1 relates to a general manager who spends approximately 1 day per week discussing matters relating to the creation of the asset. The ATO considers that discussing a major project is a normal part of the operations of a general manager and that the individual is not employed in the construction or creation of the asset. The ATO places administrative support functions such as HR and legal in the same category, and those wages would generally be fully deductible as supporting those projects would be a normal part of that job. There are exceptions, however, as always. Example 1 can be contrasted with Example 2, where the salaries of the central project management team and procurement team of an asset construction are considered capital and not deductible under 8.1. The difference here is that in Example 2, the team is specifically employed to manage the project, and support functions such as HR are also included within that team to the extent that they're engaged specifically for that capital project. The examples are fairly black and white, and therefore practically it might be helpful to think of the costs in a but-for manner. So that is, but for the creation or construction of the asset, would the employee's role exist or be materially the same to that which it otherwise is? And if the answer is no, then the costs may not be deductible. The ATO also addresses instances such as where there are project delays and employees are either redeployed, in which case the wages will not be capital until the construction recommences, or not redeployed, in which case the wages will remain on capital account, notwithstanding no asset is being constructed. In reality, it's hard to imagine a situation where an entity would continue to pay someone but not redeploy them. In several of the examples, the ruling refers to costs associated with investment decisions, but does not indicate that those are capital in nature. The ruling therefore appears confined to only the construction or creation of the asset, not the decision to construct or create. And for this reason, we don't consider salary costs associated with the acquisition of capital assets to be covered by the ruling either. So as always, if you have any questions about the ruling or you would like to discuss it further, please get in touch with your RSM team. Yours in tax, Belinda.